Hi, I'm Grant Abbott and I'm Chairman of the Australian SMSF Members Association, or better known as ASMA. Today we're going to be talking about the 8 benefits of self-managed superannuation funds. For many people, self-managed super funds are an enigma. They don't really understand what they're about, they don't understand the benefits. They may read an article in a magazine, they might see a newspaper article or see something pop up at budget time and wonder what it's all about. Many people are quite comfortable sitting in industry funds and also retail superannuation funds. In fact, superannuation to me is probably really God's gift to saving, particularly if you're looking at saving for retirement. But when it comes down to self-managed super funds, they're a lot different. They're not just simple, plain vanilla retail and industry funds, they have a little bit more. And today I want to take you through the 8 benefits of a self-managed super fund. Now, first off, I want to give a bit of a warning here for you, is that if you are in a retail fund or an industry fund, you must really be careful and take a lot of time to work out whether you do want to jump out on your own. Effectively, you are on your own in a self-managed super fund and really take control of your own superannuation. If you're someone who's sort of laid back, really not interested in your retirement, don't want to make investments yourself, you're really happy going along with the flow, then really a retail or industry-based fund is really up your alley. Don't make the step of going through a self-managed super fund. But for those who want a bit more excitement, those who want to really press ahead and become a self-funded retiree, really make the most of the opportunities, I suggest that a self-managed super fund may well be for you. So let's go through the 8 benefits. First and probably the most important for me is engagement. Once you make that line or you step across that line in terms of superannuation, you decide to leave behind the, I suppose, paternalistic industry funds and the retail super funds, you move beyond and actually start to take control of not only your super, as you'll see a little bit later on when I talk about it, but your family superannuation. Once you move beyond that line, you need to become engaged. Unfortunately, many people inside self-managed super funds, and again, this is the risk that I was talking about, many people inside self-managed super funds have large cash holdings. They've got those large cash holdings because they've, more importantly, decided to get away from retail industry funds and simply go into self-managed. They'd probably be better off staying inside retail industry funds just in a cash balance. But from our perspective, if you move over and you become engaged in your self-managed super funds, you need to start to choose, what stocks am I going to go? If I'm going to go into shares, what managed funds am I going to choose? Am I going to invest in property? Am I going to borrow to buy a property? Am I going to buy a property for my business premises or my business and then lease it back to my business? There's a lot of opportunities. Which members of my fund am I going to bring in? My family am I going to bring into this fund? Am I going to bring my children in? Am I going to bring my parents in? Am I going to bring my daughters or sons-in-law into the fund? Bearing in mind that with a self-managed super fund you can only have 4 members. So the first one is getting engaged. One of the most important things about engagement is then to become knowledgeable in what is a self-managed super fund. To put it simply, and there's a lot of information, in fact, go onto the ATO website or certainly go to the ASMA website, www.smsfmembers.com, and have a look at all the information around self-managed super funds there. From that perspective, self-managed super fund is a fund where you can have up to 4 members only, but all members must be trustees of that fund. Or the better way of setting it up is to actually have a corporate trustee, a company that stands the test of time. With that company, all members must then be directors, unless they're under 18, of course, and in that instance then essentially what we do is mum or dad who have the kids inside that fund who are still members, they simply act on their behalf. So we've got this 4-member fund. Once you're in there, you're all directors, you're all trustees, you're in there to really start to engage and start to make decisions about your retirement, making decisions about your long-term future. Because if you have a look at all the statistics, that a simple 1 or 2% extra return over a 30-40 year period can make a huge difference to your retirement income. And let's face it, at the end of the day, what we want to do is make sure that we live long and live gracefully in our retirement. The more that we have in our nest egg, the less we have to worry about our healthcare, the less we have to worry about handouts from government. Because as time goes on, and we're already starting to see this in Australia, things are getting a lot more constrained. Healthcare costs are going up. It's a lot harder to afford decent aged care. So really, start to get engaged. The first rule, if you're in a self-managed super fund, you need to be engaged with your self-managed super fund. The second rule, probably to me, is the most important, and it comes down to investing. You've made the choice, you're becoming engaged. One of the most important things that a lot of people choose to go into a self-managed super fund is to choose their own investments. You see, over time, we're going to end up that where you work for someone, 12% of your salary is going to go into superannuation. More importantly, if you're self-employed, you can make contributions of potentially up to $25,000 or tax deductible contributions, or if you're an executive, salary sacrifice of $25,000 each year. That money goes in. Now, if we've got this family super fund, which I'm going to talk about a little bit as my next benefit, if we've got this family super fund, we've set it up, we're going to have husband and wife or spouses together who can then put in $25,000 each with a salary sacrifice or personal deductible contributions, and that money, $50,000, must then be used. And this is where we start to work it. It's no good just sitting in cash. Cash is probably the most riskiest investment for you long term in terms of your retirement. Cash barely keeps up with inflation. You need growth over the long term. A 40-year-old shouldn't be in cash. Even a 50-year-old shouldn't be in cash. They should be fully invested. Now here's the thing is, at the end of the day, it seems to me, unless you're a balanced investor, and that's generally if you go and see a professional investment strategist inside a self-managed super fund or a financial planner who'll balance the whole portfolio, you're either going to be one of two things. You're either going to be a share investor or a property investor. So if you're a share investor, then $50,000 will get you a long way to acquiring a really good parcel of shares each and every year. On the other hand, if you're a property investor, $50,000 isn't going to buy you part of a property. However, it can put you down, or can effectively be a strong deposit in order to acquire property. Now that we can borrow to acquire property inside our self-managed superannuation fund. But notwithstanding that, we need to sit down and work out our investment choices. But a couple of rules here. Any investments in the fund you cannot use yourself. That's a breach of what we call the sole purpose test. You cannot use them yourself unless it's business real property. You know, property like a farm, property like your offices, property like a factory that you're actually going to be engaged in your business in. Otherwise, you can't use the assets of the fund yourself. You can't go and get a vintage car and start using it yourself. You can't then go and buy a property inside the fund and then live in it or put your kids in there, even if they pay market value rent. So that's really important. You can't use that investment yourself. You can't lend money to yourself. You can't lend money to a related party. So you just be very careful about that one. Just as an aside, certainly one of the traps and pitfalls of doing a self-managed super fund, it's great to be engaged, but there's a whole lot of different compliance issues, and you really need to make sure that you get strong, professional, strategic advice from either your accountant or a specialist SMSF lawyer or SMSF specialist advisor or a financial planner who has got the skills in this SMSF area. Now, that's the second benefit, which is making your choice of investments. Engagement first, then start to invest. The third one, and this is where I see that a lot of people make a mistake, is that they don't really start to bring their family in. If we're going to get engaged in there, we find that around about 70% of funds are effectively mum and dad funds. The children aren't inside the fund. More importantly, that gets a bit dangerous, that when mum or dad dies, that we end up with a one-member fund. That could be very dangerous, particularly if the remaining member ends up being in a position of losing their mental capacity. Who's going to run the fund then? You've got to, when you go down this process, you have to understand that the self-managed super funds go into perpetuity. The rules against perpetuity, which usually apply to trusts, don't apply to self-managed super funds. So when you set them up for multi-generations. And if you've got that in mind, then you start to think about, well, which members of my family will I bring in? Now, bearing in mind what I said before, how many members can a self-managed super fund have? That's right, you can only have 4 members, which means you have to be very, very focused on who's going to come into the fund. I would suggest you don't have daughters-in-law or sons-in-law, mainly because if there's a divorce, and let's face it, 50% of all marriages end up in divorce these days, and it also applies in the same instance if they're in de facto relationships, that effectively family lawyers from your son-in-law or your daughter-in-law, if they've been divorced, and they can start to devour or start to look at the insides of your self-managed super fund. So you don't want to basically have that. So you can bring your children in, but again, be careful about which children bring in. So the next benefit, and it's probably one that not many people really focus in on, and that's insurance inside a self-managed super fund. Insurance inside a self-managed super fund is beneficial from a tax perspective. First and foremost is that the fund generally gets a tax deduction for salary continuance, for TPD or total and permanent disability, or life insurance inside the fund. Unfortunately, the fund doesn't get a tax deduction for trauma, and that probably should be sitting outside the superannuation fund. But more importantly, when the fund claims that policy, in effect what will happen is there's no tax inside the fund. So it's a great place to have it, and at the end of the day, when the fund claims that money, they can then do something with it. For example, if you have a look at retirees, it doesn't make sense inside the fund to look after mum and dad if they're already retired. But mum and dad should actually be looking at using the money of the superannuation fund, the earnings of the superannuation fund, or even the contributions being made to the children inside that fund in order to provide a life insurance policy, whether it's a $500,000 policy or a $1 million policy. You see, if something happens to them like a permanent disability or if a life-threatening illness, what will happen is that money can come out of that policy and then be used to fund, for example, the child under the disability, pay an income stream for them. Now, let's face it, if something like that happens and you haven't got insurances in place, it means that the financial future of mum and dad is certainly going to be limited if they want to look after the child. The reverse is also useful if if the child dies. Obviously there's going to be a payout there. If mum and dad are dependents, and there's been a number of cases on this, Malik's case and Fall's case, both where the parents were seen to be dependents, in that instance what we can have is the money can go back to mum and dad, and essentially most of the time it will come out principally a fairly concessional tax rate. But more importantly, if you've got grandchildren there, that money can be used in the fund to pay out income streams to your grandchildren. And it's a great idea simply by looking at insurance inside the fund. But again, have a chat with your specialist advisor in this and they'll show you all the great benefits of having insurances. It's probably the weakest part of self-managed super fund strategy. In fact, there's only around about 12% of self-managed super funds who have insurance, compared to almost 90 to 100% of industry and also retail funds. For me, those sort of funds are great if you want insurances. If you're jumping and becoming engaged in the just family superannuation fund, make sure that you look at insurances. So that's benefit number 4. Benefit number 5 is a pretty important one, and that's the new borrowing rules. Look, I have to put a caveat here, they're not going to be around for a long time. They're too good to be true, but mainly all the major banks, all the credit unions, they all offer the ability now for a self-managed super fund to borrow in order to acquire property. Unfortunately, it's very difficult, except in extreme circumstances, to borrow to acquire shares. So if you're looking at getting leverage inside the fund, then really property is where you want to go. Again, for retirees, probably not the right investment for you. You don't really want to leverage at that point in time unless you're really gung-ho. I met one participant who came along to one of my talks, and I do probably about 3 or 4 talks a week. 70 years of age, he's gone down the track and borrowed to acquire 2 properties. Unfortunately, I said to him, well, why would you be getting leverage at your age? And he said, look, my mother is 99 years of age. I'm going to live another 30 years. I need to maximise my growth. He's going to look at working until he's age 80. So from his perspective, completely different, very unique. Borrowing is really probably for people between 30 to 50 who might have a bit of a balance in a self-managed superannuation fund. Then they can borrow up to 70 to 80% in order to acquire property. There's a number of rules around this, and certainly if you want to go and have a look, if you are going to YouTube, you might want to just type in Grant Abbott or SMSF Strategies, which is the firm that I work for, and have a look at all the videos that we've got there on borrowing. We've got a whole lot of videos on a lot of the issues we're talking about today. But leverage, the ability to borrow to acquire a property inside your fund, is absolutely phenomenal, particularly if it's also your business property as well. You're going to lease it back to your superannuation fund. So that's number 5. Number 6, which is also important, is controlling the taxation inside that fund. We've got a particular circumstance that you really don't see that much inside an industry or retail fund, where you've got an accumulation side of the fund. That's where you're accumulating wealth, and then you can start to take an income from that fund. Taking income from that fund moving an asset from the accumulation side to the income side, and this may well be when you're taking an income stream such as a transition to retirement income stream or an account-based pension. When you move from there to there, there's no tax payable inside the fund. But the key thing for us is the accumulation side is taxed at 15%, whereas the pension side, there is no tax. So at some point in time when we turn age 55, when we are able to take a transition to retirement income stream, for those people who were born before 1960, once you turn age 55, you can move assets from this side, your accumulation side, and you can move them inside to your pension side and then start to access that money. And if you've done the right thing, once you turn over age 60, it comes out tax-free. So let me just give you a little bit of a strategy around this, show you what you can do. Effectively, what we can have is a position whereby we make those contributions each year. As I said before, under the current rules, you can make $25,000 salary sacrifice or personal deductible contributions if no one else is making contributions on your behalf. So that goes inside the fund. If you've got a spouse, that goes inside the fund. You've got $50,000 to play with. That then enables you to effectively go out and leverage as much as possible. You can get up to 80%. If you've got the wherewithal yourself, if you can actually self-lend to the fund, you can self-lend to the fund at discount interest rates. You can go up higher than 80%. You can go up to 100 or even 105, 106% to cover stamp duties. But effectively what we do is we set up a structure, and again, all the things that I'm talking about, you really need to get a really good professional advisor to help you. But we effectively set up that structure and then we're off and running. Now the beauty about this is that once that structure is sitting inside your self-managed super fund, you're going to have your contributions as your deposit, and remember we're getting a tax effect that the company or our business is getting a tax deduction for us to make a deposit in terms of a property, which to me sounds amazing. That property itself will then get a return, and from that we may have an excess of costs or taxable costs such as depreciation, capital allowances, and also the interest that we have to fund back to the bank, so that we end up negative gearing inside that self-managed super fund. Now the beauty about the negative gearing inside the self-managed super fund is that each year when that $25,000 or husband and wife, the $50,000 is coming over, it's coming straight out of the employer, it's coming straight out of your business, and it's going straight into our self-managed superannuation fund. That means there's no tax outside the fund, particularly effective for high net worth taxpayers or people on high income. We move them over into the self-managed super fund. It is taxable inside that fund. And when I mean taxable, that $50,000 or the 25 apiece all becomes part of the fund's assessable income. Now if we've got gearing deductions or negative gearing of say $5,000, $6,000 or $10,000, it's going to reduce the $50,000 down to $40,000. If we've paid off some premiums for life insurance for members of the fund, again that's deduction, and the more we can shrink that $50,000 of taxable income down, the better off we are, because it means we don't pay 15% contributions tax, we're going to find a lot smaller amount. So it's a great way with property to go in there. For the smart people, go and have a look at the National Rental Affordability Scheme, where you can get $9,000 or $10,000 per year. Have a chat, it depends on what year we're looking at, what the indexation rate is, that you can get back as a tax refund inside the fund. That may get rid of your contributions tax liability altogether. But that's in the accumulation side. So what we want to do is when we do buy the property, when we're using our borrowing, what we want to do is hold it for a long time, to age 65, 70. Make sure you're getting a good rental yield there. By the age 65 to 70, you may well have to sell that property in order to cash out, in order to fund future ongoing income. Move to more a cash or fixed interest style of investment. At that point in time, what we want to do is sell the property. But where will the property be? Remember, we're getting tax deductions for this investment inside the fund. Those tax deductions are going to, if we're negative gearing and wipe out our contributions tax, we're going to end up on the pension side. And remember, on the pension side, if we sell out of there, how much tax is payable? That's right, it's zero. And then if we pay that as an income stream to ourselves, if we're over age 60, effectively it's tax-free. It really marries, from a tax perspective, the best of all worlds. We get the ability of negative gearing with also the tax-free status like our principal place of residence. So that's number 6. Now, one of the most important engagement things we're going to look at, and this comes up as benefit number 7, is what to do in the event of your death inside that fund. Unfortunately, many people are still relying on really old law which deals with doing a binding death benefit nomination inside a self-managed super fund. There's been a case, Donovan and also a Commissioner's ruling, which basically says the law that provides the ability to do a binding death benefit nomination only applies to industry and retail funds. In order to determine what you really want to do in terms of passing out your wealth, and I'm going to give a couple of strategies around this in terms of self-managed super fund, what you need to do is focus back on the trust deed. And it's absolutely crucial that you do get a really good trust deed. All the strategies I've been talking about are immaterial if you've got an old deed. And by an old deed, I mean something that predates 2010. You need to update your deeds at least every couple of years because the laws change that much every couple of years. As I said, binding nominations and also the latest borrowing rules, they weren't around in 2010. There's been changes to cases, so you've really got to be focused in on that. Anyway, getting back to our estate planning. Remember in the last instance when I was talking about taxing the fund, we had two sides. We had an account, we had effectively our accumulation fund and also our pension side. Remember the 15% and also the zero side. Well, this is the way it works. If you die when you're still in the accumulation side, you need to plan for it. If you don't plan for it, the trustee of the fund generally has complete discretion as to what they want to do, and that's not a good place to be. So what we want to do is we want to sit down, we actually want to start to make a plan in relation to what happens there. And we can set down a set of binding directions to the trustee. It's like a contract between you and the trustee of the fund or the future trustees of the fund. This is what I want to happen in terms of the event of my death. Now, what a number of practitioners call it, is something so you can get a good understanding of it, they call it an SMSF will, which is just simply a set of binding directions that deal directly with your super benefit for that money to be passed out according to your wishes to your dependents or accordingly over to the estate. Now, the benefit of paying it directly out to your dependents, and dependents in this instance include your children, anyone who's financially dependent upon you, and of course your spouse. The ability to pay it out directly is that it can't be challenged at law. If you pay monies out to the estate, effectively there can be challenges or attacks on that superannuation money under various Family Provisions Act. Be careful though, each state has its different benefits, so you probably want to see a really good SMSF estate planning lawyer to make sure you're doing the right thing. But effectively, we want to pay out an SMSF will. It's a great opportunity, set of binding directions, much the same as a will outside the fund. If you've simply looked after your superannuation, your will outside the fund means absolutely nothing. Everything must be done through your superannuation trust or your self-managed superannuation fund. So accumulation side, SMSF will. On the pension side, it's different. Once you start to commence a pension for yourself, the way to do it is not to set up an SMSF will, but rather inside the pension documentation or when you establish it, what you want to do there is make sure that it passed the parcel. You pass it on. So it may go from dad to mum, and we call this an auto-reversionary pension. It's estate planning built into that income stream, into that pension. It goes from dad to mum, and then if there's children alive and children are under age 25 and they're financially dependent, it can then go to the children, or alternatively it can go dad to mum and then on to the estate to look after the children. Again, it may be subject to challenge at that point in time, but you want to pass the parcel as fast as you can go. Again, go and have a look at the ASMA website, www.smsfmembers.com, or simply search for me on Google, Grant Abbott or SMSF Strategies, the firm that I work for. There's quite a lot on auto-reversionary pensions and estate planning. But again, it's a really key principle there for us, a great benefit. These are all these sort of things that aren't available in industry or retail funds. You certainly can't get a reversionary pension in an industry or retail superannuation fund. The final one, and I'm just going to put it to you, unfortunately, I'm a baby boomer. People born between 1946 and 1964, as many of you watching this may well be. If you're a younger generation, well, your parents probably going to be baby boomers. We're in that invidious position that by the year 2030, there's expected to be 1 million Australians who will suffer from dementia, which really, for a lot of purposes, may well be Alzheimer's. They won't have the capacity to look after their own affairs inside the fund, which is all very well. What we've got, and particularly again if you're using a good deed, what happens is if you lose your mental capacity, you can find your executor or the person who has your enduring power of attorney. And it's important, if you're getting engaged and you want to make sure you have one of these funds, to have someone with an enduring power of attorney. If you want to do that, your person with your enduring power of attorney can effectively take over your trusteeship or your directorship if you've got a corporate trustee. Again, the way that I said is the preferred methodology of having trustee. So they'll take over, but importantly from that perspective, if they're taking over, they're taking control, you've got no capacity, they're looking after your affairs, you haven't given them any guidelines, you haven't given them any directions, and more importantly, you're giving them full discretion as to what they want to do with your monies. They can pay it all out to themselves if you're over age 60 and effectively look after your needs outside of super. They can close your accounts inside the fund. So what we've done is we've come up with certainly there's a number of practitioners and I'm for one, and I've done quite a bit on this. Again, go to the YouTube channel on what to happen in the event of dementia. What we've put in place is, again, much the same like benefit number 7, where we leave a set of binding directions in the event of our death. What we do is we now leave a set of binding directions in the event of our death to our enduring power of attorney. It means they have to look after us in a certain way, shape or form. They can't just simply close our account and have full discretion as to what to do. We call this, again, just for ease of terms of reference, an SMSF living will. One is that it has capacity, first off, to make sure there's an appointment of your enduring power of attorney to take over as your trustee. So that's the first thing. And then is also to say, well, really, we want to continue our income stream if we've got it. We want to make sure it meets our living needs. If we need to get an aged care place, it's going to meet those sort of needs as well. Also prevents them from taking a lump sum and using it for their own purposes. Again, it's just a contract, it's something to be safe, and sometimes it's better in terms of family situations or external people acting as enduring powers of attorney. Sometimes it's better to be safer than sorry. And so that's the 8th benefit for a self-managed super funds. So we've been quite through a lot here to really get your mind around it, but I take you again back to that first benefit, which is the engagement. If you're going down this track, I've just given you a little potted summary on each of these benefits. There's a whole lot more to read, a whole lot more strategies around that. I've only given you one strategy, and that was talking about the tax and the fund. There's hundreds of different strategies, little nuances in the law, really great opportunities sitting there that's absolutely crucial to look at. Get yourself a really strong advisor, someone who's got a lot of clients in this area. There's now a number of professionals that have come from the accounting, financial planning profession, or even legal profession, who simply just do self-managed super funds. That's their bread and butter. And let's face it, it's such a huge sector. By the year 2018, it's expected to hold $1 trillion of assets, a large part of Australia's wealth. So because it's a large sector, make sure you get a good specialist, someone who can help. But don't expect them to know your family circumstances. What I always say to people is make sure you learn as much as they do. Go and buy the books. I've got a number of books on self-managed super funds. Go and have a look at them. You can go to www.cch.com.au or just do a search. There's a lot of material, there's a lot of good education providers there. And as I said, if you're part of the SMSF Members Association, we provide a lot of education, a lot of videos, a lot of articles there for you. Anyway, it's Grant Abbott, Chairman of the Australian SMSF Members Association, talking about the 8 benefits of self-managed super fund. If you're looking at moving over, be very careful, get advice. If you're inside a fund, if any of these things are of interest to you, make sure you go and have a chat with your advisor around them. There's some great opportunities out there, but again, as we've seen by all governments, opportunities aren't open-ended. They only last a short period of time. Get in, set yourself up, get engaged, and really make this fund a strong family superannuation fund. Thank you.